You're listening to The Dealmaker's Edge with A.Y. Strauss, diving deep into stories behind commercial real estate leaders. Hello, everyone. Welcome to The Dealmaker's Edge. Today, we're going to be joined by Jeff Gronning, who is currently the CEO of Cannon Hill Capital Partners. Cannon Hill was formed through a management-led buyout of the investment management business of Columbia Property Trust. And prior to founding Cannon Hill, Jeff was Executive VP and Chief Investment Officer at Columbia. Prior to that, he spent 15 years at Normandy, where he co-led the growth of a vertically integrated real estate private equity firm. And before that, he was CFO of Morgan Stanley's real estate investing division. This is a great conversation. We're going to learn what Jeff's excited about in this market, how he's navigated through early days of the RTC to the GFC, through COVID, through today, what's compelling about what he's seeing in the market, how he's navigated the ups and downs, and just sort of how he's making deals pencil today. So it'll be a lot of fun to talk to him. I hope you enjoy the conversation. And without further ado, here we go. Hello, everybody, and welcome to the Dealmaker's Edge. Today, we are joined by a very illustrious guest, Jeff Gronning, who has taken time out to share some wisdom, share his background, share his career stories. He's done some amazing work over his career, and he's had a fantastic, successful journey in commercial real estate, and we're excited to learn from him and hear from him. And thank you for being on today, Jeff.
Thank you, Aaron. It's a pleasure to be here.
We usually like to go in the Wayback Machine a little bit, not too heavy, not too deep, but sort of where you grew up, how you grew up, first job in real estate, where you went to school and the like.
I grew up in Northern Virginia, just outside of Washington, D.C. Grew up in a bit of a real estate family, so I think I've got real estate in my DNA somewhere. Although I went to school at Virginia Commonwealth University and graduated with a degree in accounting, and spent the first couple of years of my career at Coopers Lybrand, which is now part of PwC in Washington, D.C. When I went there, I went on it with the intention of working on audits of real estate companies. But this was 1990, and it was the sort of the RTC days, if you will. The clients were evaporating at a pretty rapid clip in those days. I had the good fortune of actually getting assigned to a consulting engagement on a DC developer that had gone bankrupt. And that was actually really my first entree into, kind of real estate investing, the capital market side of the business. And I did that for a year or so, and then had the opportunity through that engagement to transfer up to New York City, where a short time later, I took a job working at Morgan Stanley. And I didn't know it at the time, but the job was in the accounting area, working on Morgan Stanley Real Estate Fund number 1, really at the beginning of real estate private equity as we know it. And that turned into a tremendous opportunity, learning opportunity, growth opportunity. I was able to, migrate from accounting background into asset management acquisitions, and wore a bunch of hats at Morgan Stanley over, roughly a 13-year period that firmly launched me into the real estate private equity career track that I've been on ever since. So
That's awesome.
Interesting roundabout way of getting to where we are today. But in total, I've been in the business for 35 years. So
it's incredible.
It's been a great run.
And at Morgan Stanley, I mean, you were the CFO of the real estate investing division, which is a serious
That's
role.
right.
And 12 years there, it's like a $13 billion asset portfolio, if I'm getting my numbers right. But it was major responsibility and early stage. I mean, you weren't far out of school, so you really grew up there very fast, it seems like, in the business.
Yeah, it was great. I don't think I can express enough appreciation for what, working at a firm and a platform like that did for me in terms of my professional development and career and relationships and network and the like. So, it's a real highlight in my history.
Yeah, it's a great touching point for people who are in their career. Everyone wants to be an entrepreneur, but there's nothing wrong with going to work at a real institution to start. You understand training and polish, and honestly, just the people you meet in your orbit go on to become partners, clients, friends, what have you. So that's terrific. And then from there, I know you transitioned over to Normandy, correct?
That's correct. I left Morgan Stanley in 2005 to team up with two partners, Finn Wentworth and David Welsh. And together, the three of us grew Normandy Real Estate Partners into a vertically integrated platform that went on to raise four value add funds, an opportunity zone fund, a couple of separate accounts. And, we grew that business from just a handful of people in 2005 to over 100 people over about a 15-year period before we sold the company in early 2020 to a company called Columbia Property Trust. Yeah, that was sort of the next leg in my real estate journey, shifting from much more institutional, Morgan Stanley, big global platform, into a smaller, privately held, vertically integrated, operator, fund sponsor, developer. So is a pretty significant shift. But what I was able to do is actually leverage a lot of the relationships and the knowledge and the institutional upbringing that I had at Morgan Stanley, and use that experience as an asset to help grow, a smaller, much more entrepreneurial and nimble, operator, sharpshooter is, I think the term we were using at the time when we started. And that worked out well for all of us.
Definitely. I remember the first time I've heard of Normandy was probably '07 and '07 to '08. What a different world those were in. And I remember some of the deals I
Yeah.
remember reading. I mean, it was in the darkest days of the GFC where you couldn't pay a client to buy a property. There's zero liquidity. Market froze. And I remember reading about the acquisition of, was it the Hancock Tower? Was that what it was?
Right.
The huge office
Yeah.
building
That was
in
the big one.
Boston,
Yep.
and almost being alarmed. How did these guys do that? So clearly
Yeah.
it was your brains and your partner's brains to pull off, deals like that in a market that had no movement whatsoever, nothing. And to take down big deals like that, I'm sure that's illustrative of the capacity you guys had and the brain power and the capital at a time where it was all frozen up. So that was really cool to watch.
Yeah, it's interesting because a lot of things have to go right, to pull something like that off. So fortunately for Normandy Real Estate Partners, we had raised a fund that had some dry powder right as things were going to hell in a handbasket. And so we were able to use that dry powder to be, somewhat active during the worst part of the market, maybe in a way that others weren't, when you kind of look back on it with hindsight. But I would say also what was a real advantage for Normandy was the capital markets expertise that we had. Not only could we operate real estate, value real estate, manage, develop real estate, but coming from Morgan Stanley, where I was the chief financial officer and responsible for a lot of our capital markets activities for a number of years, the ability to understand the capital stack in a way that probably other, more similarly situated firms weren't, just because of that different background. And then tap into the capital markets relationships with, decision makers as some of the, the big institutions that were at that time, looking to shed assets at any cost. It's a different market today, but at that point in time, you could go direct, principal to principal, buyer to seller, and negotiate a deal to buy defaulted loan or debt at a discount. And we had the ability to not only access those opportunities, but underwrite those situations and then ultimately navigate our way through, the capital stack on John Hancock Tower, but others as well, and control that real estate, which is really the name of the game for a vertically integrated operating company like Normandy, is to get your hands on the real estate and then create value, at the operating level. And that's what we did in that situation and others. And something hopefully we can do more of today, given that, the markets are down and, you'd like to think there's a similar opportunity out there.
Definitely, when you apply that experience to those relationships and the dry powder, anything's possible. But even having the courage to pull the trigger, I mean, that alone is part of it. So that's incredible conviction. Fun fact about one of your partners you probably didn't know, but I was permitted to try on Vin Wentworth's Yankees World Series ring one time at the office at a closing that I was handling with him when I was had a prior big firm. So fun fact. But from there, after the purchase, after it was bought, came into Columbia Property Trust, and then from there, Cannon Hill, your capital partners, or your partner now, that kind of spun out of that natural trajectory. Maybe you could talk about the current platform, some of the deals you've looked at, you've done, what you're looking to do, how you're formed, what's interesting to you today.
Yeah, so I think it's probably helpful a little bit to understand the history. The way the Columbia transaction came about, we had built up this successful private firm over a number of years, and a lot of what we did was joint ventures with other sources of capital, one of which was Columbia Property Trust at the time. We had ultimately did 3 joint ventures with Columbia, between Columbia and Normandy. And I think I realize now, Columbia, is a public company, office REIT, gateway office focus. There was a lot of overlap between Columbia's markets and Normandy's markets. And what Columbia had was a permanent balance sheet, a publicly traded balance sheet. And they had core assets, very high quality, stabilized core assets. And what Normandy brought to the table was the ability to raise capital in the private markets, which, if you follow the REIT industry, they all chronically, I think, for office REITs trade at a discount to NAV. So it's very difficult to raise public equity when you're, trading below your asset value. And so what Columbia was looking to do and other public office REITs are looking to do is like access private capital. And we had a private capital machine at Normandy that was capitalizing deals, including with Columbia, because they were, leveraging their public balance sheet to do business with us. And what I also realized is public companies shouldn't be allocating capital to private operators and paying promotes. They should be doing that themselves, right? And so it made sense for Columbia to want to combine with Normandy to augment the capabilities of the combined firm to be able to go and expand beyond core public assets, publicly traded assets, into private capital, value add business plans that could drive growth for the combined company. And so that was the original intent of the transaction that we negotiated between Normandy and Columbia. And what ended up happening was we negotiated the transaction during call it the second half of 2019, and we closed it in January of 2020, which was right before COVID hit. And we brought over 85 Normandy employees to join, call it 85 or 90 Columbia employees. So kind of like doubled the size of the company. But because of COVID, we were doing Zoom calls like we're doing right now. And we were never really able to integrate the company, the cultures, the business plan, the strategy. And it is very challenging, right? So for months and months and months, we were, kind of on our back foot on defense, if you will, not able to move business forward. And then being a, sort of undersized gateway office player attracted the attention of activist investors. And one thing led to another. The board had to run a strategic alternatives process, which culminated near the end of 2021. So, a little less than 2 years after we merged in with Columbia, culminated in a take private of the company that was in a transaction that was sponsored by PIMCO and a bunch of the funds that they manage. And so the whole time we were just on defense, right? And not whether it's a company for sale, dealing with activists, just dealing with COVID and the impacts of COVID on office real estate in particular, clawing out of that at a very slow, kind of slow trajectory. The whole business plan, the whole concept, the whole strategy behind bringing the two organizations together just never really gelled for reasons that, frankly, were beyond anyone's control. And then so when PIMCO announced that, or the company announced that they were selling the company to PIMCO in a go private transaction, what became very clear to me at that time also was that if you're sitting in PIMCO's seat and you're looking at Columbia Property Trust, what you see is a big portfolio of core assets that have low corporate level debt, investment grade debt, and 120 million shareholders making up the equity base. And that got financed with CMBS debt, other loans, and then levered up 1.4 billion of equity or so. Went into that transaction. That was coming from PIMCO, the acquirer, and then there was no equity required to sort of step in and assume what we were running on the other half of the business, which was the old Normandy legacy book of business, because it was all commingled funds, small GP investment, but obviously revenue streams and a lot of people and, resource allocation going into managing, what was an equal sized portfolio at the time. And so for me, that created an opportunity to go back to the folks that were running the deal at PIMCO, Nelson Mills, who's the CEO of Columbia at the time, and negotiate for myself and 55 other people to spin out, sort of effectively unwind the transaction that we closed in 2020 and create this new company, which we rebranded as Cannon Hill, which for all intents and purposes is what Normandy was, what Normandy became after we had merged it into Columbia. So it's a little bit smaller. There'd been some runoff and some assets. There were some folks that we used to work with at Normandy that stayed with Columbia to help run that portfolio for PIMCO, and they continue to do that today. But we had the opportunity to set up Cannon Hill Capital Partners, and what we are today is a value add, vertically integrated, 60 employee, privately held company that has a lot of the same look and feel of what Normandy had back, prior to the sale in 2020, but just under, a different brand with, sort of, I'd say different leadership too. A lot of the former partners of Normandy are doing great things, just, on their own or in different capacities. But the successor company to Normandy is Cannon Hill Capital Partners.
Got it. And great overview. I'm sure a lot of your survival instinct kicked in when COVID kicked in from the GFC. Totally different story, but probably similar reaction. Oh my God, what's going on? But
Yeah.
you sort of heard that
You
story. You
have to adapt and evolve. Yeah, for sure.
100%.
Yeah.
It just makes you stronger. And maybe you can describe kind of the current capitalization, what kind of deals you're pursuing, what kind of assets you've acquired. You doing a lot of GPLP deals these days or more straight GP?
I think the most recent news on Cannon Hill Capital Partners is that late in the fourth quarter of 2025, we announced the formation of a strategic partnership with TriPost Capital Partners. TriPost is a great firm. They make platform investments. They provide growth capital to firms like Cannon Hill. And so for Cannon Hill, we are the vehicle through which TriPost and their funds investors can gain exposure to the office sector. And the opportunity there is, if you look across the office sector, there's been a lot of distress, right? When interest rates shot up, cap rates shot up, and the values were already depressed in office because of the return to, the work from home hybrid work. And even before that, for a lot of years, there's been a lot of capital allocation away from office into more niche asset classes. And so, the office space has been facing headwinds for years, even before COVID, quite frankly. And so you had headwinds, then you had more headwinds, then you had interest rates, which are more headwinds. And next thing you know, you've got values of office buildings down, 40, 50, 60, 70% in some cases. And so, at some level that breeds an opportunity, right? And what we were seeing, and I think what TriPost is seeing as well, is an opportunity to kind of come back in and take advantage of a 30-year price adjustment in the value of commercial office real estate. And, and frankly, that, if you go back 18 months ago and we were looking at an office deal in any of the Northeast markets, finding a joint venture partner to capitalize that transaction with was impossible. And now fast forward to 2025, now early 2026, and it's a bit of a different story. I wouldn't say it's easy, but there are definitely a lot more institutional investors, opportunity funds, value add funds, and the like, that are able and ready, willing, and able to take a look at an office deal. Bar is still very high, and the returns need to be high, and it's got to check all the boxes. But there is receptivity and increasing conviction around deploying, at least a portion of, XYZ funds, available capital into the office space. And so that's really what we're trying to take advantage of with this TriPost GP fund and this strategic partnership that we have. And hopefully we can grow it from here. But, with the capital that we have available to us, our goal here over the next 2 to 3 years is to acquire, upwards of $1.5 billion of distressed office, if you will, that we can, that we'll be looking to earn opportunistic returns on. That's sort of, and we'll kind of do it in three different ways. I think, one would be whether it's, distressed debt, forced sales, reset basis, into office that wants to be office. It needs, needs a new capital stack. It needs the ability to, go out and compete for tenants. Maybe you have to reposition the building, the amenities and the like. But, it's good bones, good real estate, good office real estate, and can take market share. That's one aspect of our strategy. I also think there will be opportunities to provide gap equity, whether it's in the form of mezzanine, preferred equity. There's already been a lot of that. Frankly, it's getting compressed. And so I'm not sure how deep that opportunity will be for us, but selectively, I think there'll be opportunities for us to come in and work side by side with existing owners to, fill gaps on a selective basis. And then thirdly would be conversions, which is an area we've spent a bunch of time on. There's a lot of it going on, particularly in New York City and Washington, D.C. It's hard to get those deals to pencil, but as prices have come down for real estate, the opportunity for assets to, potentially underwrite for conversion has increased, I think. And so we're doing one now in Tribeca. 101 Franklin is a vacant office to high-end residential conversion that we closed on 18 months or so ago, and will be sort of under construction here, probably the middle of this year, and beginning sales on that. So that's a good example. Another example of what we've been up to is down in Northern Virginia. We are taking a 2-building, sort of Class C obsolete, suburban office park, and we are going to demolish 2 of the buildings and repurpose that space into a quasi-industrial use, or that site into a quasi-industrial use, and and earn opportunistic returns that way. Those are kind of the 3 areas where we think we can play. And then, I think we also we want to continue our development activities. Development's a big part of, our history and our DNA. And so we've got a, kind of a forward pipeline of residential multifamily development opportunities in the kind of the northern New Jersey market that we're actively pursuing as well. So that's what we're up to these days.
And that's a lot. So congrats. And on the markets, are you looking, New York, obviously Northeast, are you looking in other markets besides the other one you mentioned, I think Virginia for office?
I wouldn't say we're proactively looking outside of the Northeast. We believe in our vertically integrated model, and we think having boots on the ground where we can execute and at the operating level, kind of have a very strong relationship network is a really important ingredient to our, past and future success. And so, for Cannon Hill, that's sort of always been, and even Normandy before that, it was, kind of the Northeast US. And so that's where we spend the vast majority of our time. That's not to say that if we're, working on some larger portfolio transaction, that includes assets and, it could be across the country, or, just outside of the Northeast region, we would, certainly look at opportunities like that as well. But I'd say, to go outside the region is a little bit more portfolio driven, I think, than to say we're going to San Francisco or LA or Dallas or someplace like that. We probably should have gone to Miami, but we didn't do
Listen,
that.
hindsight's 2020. And I want to ask you too, you've really seen the cycles, right? From the early days at Morgan Stanley to obviously GFC to COVID to what's happening now.
Yeah.
You've really ridden roller coasters up and down. And the one thing constant is you have to keep showing up, doing the work, having the conversations, sourcing deals, maneuvering through opportunities and over obstacles. Maybe we can talk about the mental edge that has to get developed. I think very successful people in my experience who ride these waves, they sort of are great at compartmentalizing or they have a way of thinking about through things that they can maintain that analytical part of their brain without sort of becoming emotional about any one
Yeah.
piece of real estate or opportunity. Maybe you can describe, how you kind of self-regulate. I think a lot of this business is just checking your emotion at the door and learning to keep all the variables at play no matter what's happening. And I think that's something that you're obviously very skilled at doing. And I think people listening to this would love to hear that.
Yeah, it's a it's a really good question. You're right. I mean, I can't even count how many cycles I've been through in 35 years, but it's been a lot. They're all painful and a little bit different. But yeah, look, I think you just got to keep your perspective. You've got to, in some ways, be unflappable, and as you said, not emotional about it. You got to, kind of take it as it comes. I mean, in some ways it's beyond your control, right? I can't control the capital markets or cap rates or office demand and things like that, but I can control what happens at the property I own, and you gotta focus on the things that you can control and not on the things you can't control, right? So I think that's really important. And I think for me, like, kind of ride the ups and downs and, come out of it and be able to say, you were successful, at the end of the day. I think for me personally, it's about hard work and perseverance, and persistence. You have to grind through it and come out the other side, right? It's all about, kind of navigating and pivoting and working hard and just being persistent about deals and assets and commitment and integrity and being a good partner and things like that are all the ingredients that, kind of help you get through and deal with the ups and downs.
Well said. I think that really dovetails into kind of the advice section we always try to peel out of our guests too, for people who always want to get in your calendar and say, how do I make it? What am I doing? I think those lessons you just imparted are just absolutely standard, and they're consistent and they're necessary for success. Anything else I could have asked you that you would have loved to have been asked that I just totally missed in the interview process, or if you don't have anything specific along those lines, anything that's very exciting to you over the next 12 to 18 months?
Yeah, like I'm excited about the vintage, that we're in. We're just talking about, markets are cyclical. I think we're off the bottom. Markets are moving up. I'm optimistic about the economy here going into 2026. Yeah, I feel like, capital is flowing into the sector where we can provide a service and a value to, larger investors looking to allocate into the types of deals that we can execute and source. So I'm really optimistic about that. I like to say there's like no excuse, right? Like, I think the wind's kind of at our back, like vacancies are declining, cap rates are coming down, values are going up, tenants are back in the office. New York City had, the most leasing volume since 2019. I'm not diminishing how hard it is to, make deals and capitalize deals by any stretch, but I hope that this is, our year or our next couple of years. And so when I look back at the best performance that we ever delivered to our investors, it was the Hancock Tower and, the other deals that we were involved in, kind of in that vintage. And we haven't had an opportunity like that in whatever it's been, 15 plus years now. And so I'm glad to be in the business in 2026 based on everything that I see and what we hope to accomplish going forward. I'm grateful for the support from, TriPost and the investors that we've invested with and the relationships that have helped us along the way over the years. And hopefully we can, do more together.
I'm sure you will, Jeff. I'm sure with your background, there's plenty more deals in the hopper, plenty more deals to execute on. And it's been great hanging with you on this podcast conversation. I appreciate you. I'm sure a lot of people have learned a lot. I learned a lot, and it's really great to hear the inside stories. So I guess with that, we'll wrap, and we'll all watch your deals in 26 and beyond. And I'm sure you'll make it a fabulous year based off a long lineage of high level performance. This is a great time to be riding up a new wave of deals. So it's going to be exciting to watch you and your whole firm behind you really do some cool stuff this year and beyond. So thanks for being on, and to be continued. A lot of continued success to you.
Thank you, Aaron. Appreciate it.
Thank you for joining the Dealmaker's Edge. Don't forget to follow us on your favorite podcast platform. And please give us a 5-star rating so more people can follow the conversation.